Three metals, three supply crises, one convergence that hasn't happened in 45 years. JP Morgan just raised its gold target to $6,300 an ounce weeks after gold hit $55.95 and then suffered its worst single-day collapse since the 1980s. Copper quietly shattered $13,000 a ton for the first time in recorded history while everyone was glued to AI stocks. And uranium just crossed $100 a pound because the world suddenly realized you cannot power a data center with a solar panel. Wall Street is publishing the most aggressive commodity forecasts in a generation, and the mines physically cannot produce enough to meet what's coming. The question isn't whether these metals are going up. The question is what happens when three structural deficits collide at the same time and there's no relief valve. That's the part nobody on financial television is willing to explain. My name is Alex, and I've spent the last decade tracking commodity supercycles and central bank policy so you don't have to. If you want to understand where real money moves before the headlines catch up, make sure to hit that subscribe button and give this video a thumbs up if it helps you see the bigger picture. Before we dive in, I want to know, are you positioned in any of these three metals right now? Gold, copper, uranium? Drop which one in the comments, or tell me if you're sitting this out entirely. Because today I'm going to walk you through the data behind the most aggressive commodity forecasts in modern history, show you why supply cannot catch up for years, and reveal the single convergence that ties all three of these metals into one trade that Wall Street is quietly building the biggest bet of the decade around. Now here's where most people get this story backwards. You hear gold hit an all-time high, you hear copper broke records, you hear uranium is surging, and your brain does the natural thing. It says, I missed it. The move already happened. That's the trap right there. Because what actually drives a commodity supercycle isn't the price hitting a new number on a screen. It's the structural gap between supply and demand that takes years, sometimes decades, to close. And right now, across all three of these metals simultaneously, that gap isn't closing, it's widening. Gold exploration spending has been declining relative to demand growth for years. Copper mines take an average of 17 years to go from discovery to full production. Uranium facilities face regulatory and technical hurdles that make new supply a 5 to 10 year proposition at minimum. So when JP Morgan, Wells Fargo, Goldman Sachs, and Bank of America all publish their most bullish commodity forecasts in a generation within weeks of each other, the story isn't that prices went up. The story is that the smartest money on the planet looked at the supply math and concluded there is no fix coming. Not this year. Not next year. And what I'm about to show you is the data behind each of these three metals that makes even the bearish case look bullish by historical standards. Pay close attention because this next section is where the real money gets made or lost. Let's start with gold because it's the one everyone thinks they understand, but almost nobody has the actual numbers on. Gold surged roughly 55 to 65% through 2025, breaking $4,000 an ounce for the first time ever in October. By January 29, 2026, it hit an all-time high of $5,595. Then it suffered its worst single-day crash since the 1980s. And right now, as of mid-February 2026, it's trading around $5,000 an ounce. Most people saw that crash and thought the top was in. Here's what they missed. On February 2, 2026, JP Morgan raised its gold price target to $6,300 by end of year, up from their prior forecast of $5,055 set just back in October 2025. That's a 25% upward revision in 4 months. And in a separate note, JP Morgan laid out an upside scenario of $8,000 to $8,500 per ounce if household gold allocations rise from roughly 3% to 4.6%. We're talking a single percentage point shift in how everyday people allocate their wealth, potentially adding another $2,000 to $3,000 per ounce. Wells Fargo Investment Institute followed almost immediately, lifting their year-end 2026 target to $6,100 to $6,300. Goldman Sachs raised to $5,400, and given that gold already trades above that number, a revision higher is basically inevitable. But here's where it gets interesting, and I need you to understand this because it explains why the floor under gold prices is fundamentally different than anything we've seen before. Central banks purchased over 1,000 tons of gold for 3 consecutive years, 2022 through 2024. That's unprecedented. JP Morgan projects approximately 755 tons of central bank purchases in 2026. Now, that sounds like a decline, and it is in tonnage, but the reason is mechanical, not behavioral. At $4,000+ an ounce, central banks need fewer physical tons to reach their target allocation percentages. They're not buying less gold in dollar terms. They're buying less weight because each ounce costs more. And that's actually more bullish, not less, because it means the buying pressure continues even as the sticker price rises. JP Morgan's quarterly demand model projects total investor and central bank demand averaging approximately 585 tons per quarter in 2026. That breaks down to about 190 tons from central banks, 330 tons in bar and coin, and 65 tons in ETF inflows every single quarter. Here's the critical threshold. JP Morgan identifies 350 tons per quarter as the level necessary for prices to keep rising. We're at 585. That's not marginally above the threshold, that's 67% above it. Gold's share of total global financial assets has reached approximately 2.8% as of the third quarter of 2025. JP Morgan describes this shift as gold moving from, and I'm quoting here, a niche hedge to a core holding. Let that settle in your mind for a moment, because that distinction explains everything about where this market is headed. Now, if you've made it this far, you're already ahead of 90% of people watching this. But don't stop now, because copper is where this story gets truly extraordinary, and it's the metal almost nobody is paying attention to. Copper hit a record $11,200 per metric ton on the London Metal Exchange in October 2025. Then it kept going. By January 2026, it reached $13,238 per metric ton, a new all-time high. It's currently trading above $13,200. Here's what makes copper different from gold. Gold is a monetary metal. People buy it because they're scared. Copper is an industrial metal. People buy it because they're building things. And right now, the world is trying to build everything at once. JP Morgan projects a global refined copper deficit of approximately 330,000 metric tons in 2026. Mine supply growth estimates have collapsed to just 1.4%, roughly 500,000 metric tons lower than what analysts projected at the beginning of 2025. That supply miss alone is larger than some countries' entire annual consumption. And then there's the number that keeps me up at night: AI data center copper demand. JP Morgan estimates approximately 475,000 metric tons in 2026 alone, up 100,000 metric tons versus 2025. Every single AI data center requires massive amounts of copper for power distribution, cooling systems, and connectivity infrastructure. Every new server rack, every transformer, every mile of cable. Copper. And this demand is growing from what JP Morgan calls a small base, which means the percentage growth rates are staggering even though the absolute tonnage is still a fraction of total demand. Citi sees copper potentially exceeding $13,000 per metric ton and approaching $15,000 in 2026. JP Morgan recently raised its long-term copper forecast to $12,000 per metric ton, citing deficits that could reach 2 million tons by 2030 and a jaw-dropping 8 million tons by 2035. But here's the part that makes this truly structural and not just a cyclical spike. It takes an average of 17 years to move a copper mine from discovery to full production. 17 years. So even if a mining company found a world-class deposit tomorrow, broke ground next month, and had unlimited capital, you're looking at the early 2040s before that copper reaches the market. The supply gap cannot be closed. Not at these prices. Not at any price. Not in any time frame that matters for your portfolio today. Now I know what you're thinking. What about the bear case? And there is one. China's demand growth is slowing, from roughly 4% in 2025 to an estimated 2.5% in 2026, according to JP Morgan. Higher prices will accelerate substitution to aluminum in some applications. The World Bank projects a more conservative $9,800 per metric ton average. And there's a Section 232 trade probe on copper imports that could create regional price dislocations. Fair points, all of them. But even the bearish World Bank estimate of 9,800 represents prices that would have been considered wildly bullish just 2 years ago. The bear case for copper is still a bull case by any historical standard. And that brings me to the third metal, the one with the most explosive upside potential and the most genuine uncertainty. But before I get there, I need to explain why uranium is fundamentally different from gold and copper. Because if you don't understand the supply chain dynamics, you'll miss why Bank of America is calling for 50% upside from current levels. Uranium's spot price rose to approximately $101.50 per pound in January 2026, the highest since February 2024. It's currently trading around $92 after pulling back on fresh supply news out of Uzbekistan, which boosted production to 7,000 tons, above expectations. But here's what makes uranium the most misunderstood of all three metals. The spot price was essentially flat throughout all of 2025, locked in a range between $63 and $83 per pound. Flat. For an entire year. And yet nuclear-related equities surged approximately 68% from their April 2025 lows. Cameco, the world's largest publicly traded uranium producer, was up roughly 70% in 2025 despite those flat spot prices. Uranium miners ETFs like URA and URNM surged 25 to 27% in January 2026 alone. The equities are pricing in future fundamentals that the spot market hasn't reflected yet. That divergence is a signal, and it's one that Bank of America's metals strategist has noticed. Their forecast calls for uranium reaching $130 per pound by the fourth quarter of 2026 and $135 in 2027, representing over 50% upside from current levels. Meanwhile, Goldman Sachs projects $91 and Scotiabank estimates $80. That's an enormous spread among forecasters, and it reflects genuine market uncertainty around inventory levels and contracting behavior. So why is Bank of America so bullish when others aren't? 2 words. Government policy. The United States government designated uranium a critical mineral in 2025. They committed $2.7 billion in contracts to Centrus and other domestic enrichers and converters to reduce dependency on Russian supply. They cut regulations on permits for uranium converters. They partnered with Cameco on Westinghouse reactor development. An $80 billion pledge for new AP1000 reactors was announced. A Trump executive order targets tripling or even quadrupling nuclear capacity by 2050. A Section 232 review for uranium is pending, delayed by a government shutdown. And perhaps most significantly, a strategic uranium reserve is being discussed that could include equity investments in producers, offtake agreements, and minimum price floors for domestic production, mirroring the tactics used for rare earth minerals. That's not a market signal. That's a policy signal. And policy signals move slower but hit harder than any trading desk. Now, here's a hard truth that might sting a little. The uranium bull thesis has been, quote, 6 months away for years. The spot price was flat all of 2025, while bulls kept promising a breakout. Sprott's CEO has publicly noted that the utility contracting cycle needs to pick up to make up for lost time. New reactor builds have very long timelines. And, as Uzbekistan just demonstrated, supply can surprise to the upside. With price forecasts ranging from $80 to $150, the uncertainty here is real. But here's where it all connects, and this is the part I've been building toward. We're in the home stretch now, and I've saved the most important insight for the end. The structural theme connecting gold, copper, and uranium isn't just that each one has supply problems. It's that all three are being driven by the same underlying force. Constrained supply meeting policy-driven demand acceleration happening simultaneously for the first time in 45 years. Gold is being driven by central bank de-dollarization and investor debasement hedging. Copper is being driven by electrification, AI infrastructure, and the green energy transition. Uranium is being driven by a nuclear renaissance for baseload power and data center energy needs. 3 different metals, 3 different demand drivers, 1 shared reality. Years of underinvestment in mining across all 3 commodities created structural supply gaps that cannot be resolved in 1 to 2 years. Copper mines take 17 years. Uranium mines face regulatory nightmares. Gold exploration budgets have been declining relative to demand for over a decade. Remember at the beginning when I said there's a convergence that hasn't happened in 45 years? This is it. The last time you had simultaneous supply deficits across monetary metals, industrial metals, and energy metals with government policy pouring fuel on demand was the late 1970s. And what followed that convergence was the most explosive commodity bull run of the 20th century. But I need to give you the risk side too, because if I don't, I'm no better than the analysts who only show you the bull case. The extreme recent volatility, gold's worst day since the 1980s, copper's wild swings, silver's crash, tells you that speculative positioning is elevated across all three markets. CME has been raising margin requirements on precious metals, which is exchange-level concern about leverage. U.S. Treasury Secretary Bessent has attributed recent extreme swings to Chinese speculative activity. If a global recession or major deleveraging event hits, all three of these metals could temporarily get crushed simultaneously. Temporarily. Because the supply gaps don't disappear in a recession. They actually get worse, since mining companies cut capital expenditure during downturns, making the next cycle even more explosive. So here's what all of this means for you. The biggest banks on the planet, JP Morgan, Wells Fargo, Goldman Sachs, Bank of America, Citi, are all publishing their most aggressive commodity forecasts in a generation at the same time. The supply math says there is no quick fix. The policy math says demand acceleration is just getting started, and the convergence of all three happening together hasn't occurred since the era of disco and stagflation. At the beginning of this video, I told you that Wall Street was building the biggest commodity bet in a decade and that the mines physically could not keep up. Now you've seen the numbers. Gold demand running 67% above JP Morgan's price increase threshold. Copper facing a deficit that takes 17 years of mine development to solve. Uranium backed by billions in government policy commitments with a nuclear renaissance barely in its first chapter. Three metals. Three supply crises that can't be fixed on any timeline that matters. And you now understand something that most investors scrolling past this on their feeds never will. Gold, copper, uranium, or all three, which one are you most bullish on and why? Or do you see a risk I didn't cover? Drop it in the comments. That's where the best conversations on this channel happen, and I read every single one. Your future self isn't going to remember what the market did on any given Tuesday, but they will remember whether you paid attention when the data was screaming and the supply math was undeniable. The information is in front of you. What you do with it next is the only part that matters.